the call is specifically about, and that's, like I said, it's just a revamp of seasonalities and pretty much talking about everything outside of the charts before we go into specific COT in a specific website. So what I usually do, and I think everybody have noticed that, is that I also have a different COT, and I usually use a COT source, multiple COT sources, multiple reports. It could be futures, it could be other commitment of traders reports, and I pretty much gathered from multiple ones. And what I usually, what you're gonna see is that you're gonna, in majority of the cases, you're gonna see a very similar report, or exactly the same reports coming into all the different COT providers, right? Now that's just suggesting that the COT data is accurate, etc., etc. So you can use multiple sources. You don't need to use market bulls, and I would suggest you to use multiple sources to double check. All right, because if you, let's say you're checking three, right, and two suggest one thing, another one suggests another thing, it's probably just a mess up in the numbers. All right, for that given thing, right? But you know, other than that, you're gonna just suggest you're then gonna go for these specific twos. But it's more or less never and just mess up in numbers. Like that usually has happened to me once, all right, and that was a long time ago. It was not for market bulls. I usually never used market bulls. Market bulls I use, is a new thing for me personally. Anyways, let's just continue. So when you pretty much load up market bulls, this is why I like it so much. We can compare it to another website. We can compare it to this one right here. In this case, you're gonna see totally different ports. We can go into currencies, we can go into FX, we can look at the very similar ones. We can look for the dollar index here as well. And you can see it looks very different, right? You have a totally different, pretty much, specific chart, right? You have a very different one, but you can see the data is very similar, right? The only major difference is overall potentially, nothing has actually, you can see potentially, you can see it a little bit clear here for Nasdaq, but it either looks like something like this when you first load it up. If you were looking for any COT sources, etc., it usually looks like this, or it usually looks like this. Now everybody now knows, or hopefully knows now, that the things we're specifically looking for is not the numbers. All right, what the majority of people do, and this data is usually from the I don't know specific website, but it's usually from what's that called? Um, the future website, right? Yeah, I'm gonna just search it up later. Don't worry about it. I'm gonna send it to y'all later. But yeah, no, I just forgot the specific name right now. But usually it comes from one source. This sometimes gather from multiple sources. I like gathering, from multiple sources, like I've previously explained. And I'm gonna check for questions pretty much at the middle of this call, so don't worry about it. Now, either looks something like this, or it looks something like this. Once you have the COT source you're pretty much focusing in on, I'm more or less using two, and one to just double check the data I'm getting provided here on, for example, market bulls. Market bulls is usually what I use because it's just aesthetically pleasing, right? Just easier for me to read it. Now, specifically here, you're gonna have a price chart, either a price chart, or you're just gonna have a legacy net. Some also provides open interest and some other instruments you could use to measure COT or change in orders, right, or change in positions overall. The commitment of traders reports, change numbers, changing how it looks. All right, like this right here. They always look at the numbers. They always look at, oh my gosh, something is happening here, or this number is changing. I don't know how to read this. All right, if I'm honest, I don't know how to read this report right here. What I'm more focused on is instead reading the numbers, but the numbers plotted on the charts. This is how I've always read COT, and this is what pretty much makes us a little bit different, because that's also something I want to touch upon, because I want to talk about what makes us different from traditional ICT traders and what makes us different from all other specific traders using COT, because COT is a well-known thing, it's not some secret here. But what makes us different is how we're actually looking at the numbers and how we're visualizing the numbers using the legacy net. Not so many people, of course, some people do, but we usually visualize it, right? Or I don't know even how to read this, but I read this right here. I visualize it and I use this. And what I'm specifically doing is looking at what or where price was during the specific orders and when it shifted, right? And how it shifted as well, which is really important. And you can usually see these large shifts in hedging positions from a central bank. Now that's also something which is real interesting. Now, what is hedging and what is this commitment of traders reports actually telling you? Well, it's not telling you if people are buying, it's not telling you if people are selling, it's not telling you the amount of people buying or selling, but it's telling you, alright, it's telling you people's orders, alright, what they're specifically looking for, but also how they're positioning themselves in a long-term, short-term format in a manner, right? That's specifically what it's showing, alright? It's showing the net positions, right? You could say the net position. It's not any sentiment, it's not any reads, it's what actual people does. And it's also categorizing these certain people to help us visualize which people is doing which things, which is why you're gonna have a commercial, which is why you're gonna have a large speculator, which is why you're gonna have a small trader, right? It's visualizing those two and is or those three and is pretty much presenting them in a manner which is pretty understandable looking at the charts, right? Now the same thing is very true for open interest, right? Very similar, right? But what it's showing is leverage positions. It's the amount of positions in the markets, you could say. So open interest, amount of positions. Legacy net is the certain positions in the markets, represented by three large groups of traders. Now, commercials, large speculators, and small traders represents pretty much the same thing in the same asset class. So you have currencies, which commercials, large speculators, and small traders represents parts, and we're gonna pretty much go into detail about what they represent specifically for currency, that asset class, but also in crypto, indices, bonds, energy, metals, grains, softs, livestocks, and dairy. This is why they have these specific categories, because in all of these categories you're gonna have different not traders specifically, but different institutions, different sort of groups of people, all right, or groups of companies, etc., right? So commercials is not going to represent, for example, central banks if you're talking about crypto, right? Commercials is going to be a different thing, but it's still going to represent more or less those people which has the insight, all right? This is why they trying to group them into three different parts and three different distinct groups, right? Which is also something we can gain insight from. So I'm just trying to go into specific detail about these specific things, so you guys, of course, can pretty much then yourself go into detail about these things and pretty much go in and focus learning, etc. Now we're gonna go straight into this. So as you all know, we're gonna talk about currencies first of all. We're gonna talk about what commercials represents here. In this case, commercials, like I said, represents institutions of people controlling the specific assets. And as you all know, currencies is made pretty much primarily to trade with, right? And now we're talking about real trading. We're talking about buying commodities, etc., buying different assets. Now we're talking about big assets, country to country based, right? We're talking about US shipping, or US wanting to buy, let's say, cars, or specific things from China. They could be, let's say, even grain, right? Because now we're talking about strategic reserves, etc. And we're talking about central bank to central bank in a commercial groups, right? Or people representing institutions which has great insight into specifically what they're looking for in currencies. And that always, commercials is always the group of insight, right, of the people with insight into controlling the specific assets. So in crypto, it's representing whales, all right, specifically, while large speculators, investors, like large investors in crypto space, but not specifically whales, right? So let's just pretty much commercials here, as I said, represent central banks or institutions more or less working for the central banks, right? Now you have large speculators. Now large speculators could be hedge funds speculating, right? Is speculators, so these people which does not have the insight into understanding where the currency, like they don't know where the currency is going. Commercials know to an extent because they're preparing, they're looking at interest rates, etc., etc. They're preparing for the future because they're central banks, right? They need to hedge positions, they need to secure their own currency, they have to defend their own interests, and they have to defend their values and the things their overall their objectives of pretty much holding a strong currency, and trying to control speculation of currency, restrict speculation of currency, and of course also focusing on economic growth. And of course, if you have a currency which is moving up and down and not stable at all, they're not achieving their objectives, so they're trying to also hold the currency stable. So of course, if you have a large down move, they're going to try to take it up so it stabilizes, all of those things. Like, and currency, like let's say an African currency, etc., etc., you can have some prime examples of central banks not doing their job and hedging their positions against other currencies. Federal Reserve, however, and the dollar is a great example of a central bank doing their job real crazy, I mean, not crazy, but real effectively, alright? And they're doing a great job of holding the dollar steady, I'll personally say. But you can also see and like I said, COT just gives you insight, and I'm just gonna pretty much talk about how it gives us insight into specifically currencies because that's what we're trading. But before that, I just want to cover crypto indices, bonds, energy, etc., etc., etc. Now, large speculators here, like I said, is pretty much representing hedge funds, large speculators, pretty much people holding large quantities of money, and they're usually always opposite of the commercials, and the commercials usually always use the large speculators as liquidity. So the central banks always used people with large pockets of money to pretty much position against them. Now you have small traders, and small traders, as you can see, us does not really have any impact at all on the markets, and usually small traders potentially could even represent brokers, etc., etc., brokers accounts hedging against the real OTC markets, because you have to realize that a large speculators is trading and openly on the OTC market and the commercials as well, while we small traders usually don't have any at all impact on the real markets. You can see we have potentially some impacts in large moves right here, but usually it is zero, right? Because we don't have, we cannot access the real markets, we cannot access the real currency markets, which is just a prime example of why currencies is not at all made to be traded. All right, a lot of people trade it, but we're not trading it. This is fake trading. All right, we're trading CFDs, we're trading fake contracts of it. So we're not really trading it. You're trading more as a demo, or you're trading against your broker. That's usually how it goes. But if, let's say, 80% of a broker or just large people in the brokerage per se take large same positions, they need to hedge against the real OTC market, which is why you can see some impact on the currency market, but not big impact at all, alright, or not large impact at all. So that's just something I need to clarify, something I need to explain. Now moving on, right, we more or less have open interest, which is what I talked about, is the amount of open positions in million positions, right? We're going to talk about it, we're going to talk about all of those things, but you can search up all of these things as well. I'm going to drop the notes after this video, so don't worry about it. But then we can also pretty much go into let's say indices, alright, because indices is something a lot of people trade, so we'll pretty much go into it. And here you can see the small traders has a much greater impact, as well as the commercials and speculators, right? Which is something you could use. So here, of course, indices is something which you actually can hedge and trade in reality, because you can trade options, you can trade different financial instruments other than CFDs, which is just fake. CFDs is just fake. There's no liquidity. You're just trading against your broker usually, or you're just trading prop firms, etc., etc. in CFDs contracts. But it still allows you to speculate in the markets. But it's not like a real financial instrument. A real financial instrument is futures, I would personally say, and options. But you also have ETFs, etc., etc., which allows you to trade, and alternative financial instruments which you can use with leverage, right? CFD, of course, can also be hedged, and I think they're much in a much closer manner hedged, because you have futures, you have other things which you can much more easily access the real markets, right? Um, and of course, this is also reported in futures, I would personally say. So I think the data here gathered is coming from futures. It's coming from the CFTC. That's where I got it, the CFTC. So all of this data is usually coming from the CFTC. You can also have alternative sources, but CFTC is usually where the sources from futures is coming in. And you can actually look at COT for futures, which is great. I would personally do it. It's updating each and every day, so you can actually check COT in real time there, and you can check all other things. You can check algorithms trading, etc., etc., which is great. It also gives you great data, but I don't really look into those things. Like I said, I'll pretty much locked in on those things which I know works or have worked for me for a long time. So those things are just what I'm specifically focusing on. Now, before we show or I show any examples of any specific things, we're gonna just talk about what the commercials represents here and what the large speculators represent here, but also what the small traders represents here. So of course, you already know, but commercials in this case does not represent or necessarily represent central banks. All right. In this case, it represents potential Wall Streeters, insiders, other large institutions which has an insight into where the market is going. Of course, it's all speculative, but they usually have a greater impact than the large speculators. While large speculators is potentially funds, alternative funds. It could be, just large investors in general, or hedge funds or whatever. But I think here this represents much more greater, bigger institutions, and not so much money managers. While here is much more money managers and individuals, and not so much large, big as institutions, right? And of course, the small traders is of course the small futures traders, so the individual, uh, like just normal traders, like I don't know, commercial, not commercial, what it's called, just specific traders, right? Just small individual traders, right? And open interest is just the amount of leverage positions in the futures markets, right? And the same thing here is true for legacy net here as well, which is just the pretty much open positions in all of them, go be it short, be it long, etc., etc. Now we're gonna pretty much cover all of this and what it means, etc., etc. So let's just dive right into a few examples of this and actually showcase or talk about it. I have done it so many times, but I'm just gonna quickly show you guys. I can show you so many real examples, and I pretty much want you guys, because I'm gonna show you two, otherwise this call would be so long, alright? But I'm gonna show you two examples when open interest and legacy net confirm the move. So we can just pretty much look at this. As you all know, we're looking at the data. We're looking at pretty much where price was and how price behaved during specific patterns of the COT and how they positioned themselves or hedged, right? Now, one specific real-time example of this, or you have 10,000 real-time example of this, is of course here in the early stages of 2024, where we pretty much saw this right here. We saw this big upswing right there. We saw this, and you have this recorded, you have this on YouTube, you have this in the server, you have this in the midterm price calls, you have this everywhere where I talked about these specific things, where you have 17th of September, we moved from a bearish hedging program to a bullish hedging program, alright? We went from minus 20,000 to minus, or to more or less zero, or even positive, which means that hedged against a bullish dollar. Now this was due to other fundamental aspects, right? This was due to the rise in yields, this was rise in interest rates, etc., etc., but also Trump coming into office and more uncertainty, which was pretty much to bring a higher dollar, because it were to bring higher debts etc., for the US, which is exactly what we are seeing. So very freaking interesting. Now, as y'all can see, this changed 17th of September 2024. Now you also saw large liquidations. Since the open interest, as I've talked about, represents the number of leveraged positions, a large drop or a large increase in open interest means either increased in leveraged positions in a very short notice, meaning price should move in that notice in a very fast manner. We're reading it very differently from all other people. And a large drop means large liquidations of leveraged positions, most notably by large speculators, because commercials trade 1-to-1, while large speculators, like I said, trade potentially leveraged positions from other financial instruments, while commercials is just hedging for potential for things, because they're only focusing on fundamentals, interest rates, etc., because they're the ones setting the interest rates, because they're the freaking central banks. So this goes into then quantitative easing, quantitative tightenings cycles, inflation cycles, unemployment cycles, and all of that rest of cyclical things which you could possibly look for. Now, we saw a big drop, as I said. We saw this large mass liquidations here at 17th of September 2024, while we saw this going from a bearish hedging program to a bullish hedging program. What defines a bullish and a bearish hedging program is a time period divided by 2. You take the large periods, low periods divided by 2. The upper period is a bullish hedging program, the low period is a bearish hedging program. So over here, minus 20,000, you have this pretty much 100, or I think this potentially is even 2,000 or something like that. Divided by 2, you get minus 10,000. Above minus 10,000, bullish hedging program, meaning here we should see bullish prices in accordance to this mass liquidation. Because as we have talked about, this is a big secret, and I'm gonna talk about it later. But 17th of September, we went from bearish to bullish hedging program. Now you can see 17th of September was here. 17th of September, we knew their positions was bullish. We knew the central banks were positioning themselves in a bullish manner. We knew they were seeking higher freaking prices for the DXY, and so we saw higher prices. And you can see 17th of September was this, and you see one more week, and then we saw great higher prices, and we saw this massive increase. Now you might be saying, well, how do you look for it to be bearish? Well, same thing. We're looking for mass liquidations, we're looking for a new all-time high here, we're looking for something like that to an extent. Now you can see we have measured out the minus 10,000 line, so we're looking at it again. And so pretty much we saw us definitely being below here at 17th of January or 7th of January right here. This is when we pretty much saw this definitely being lower than minus 10,000. And so you can see 17th of January right here. That was more or less the mark, the top of this, and for us to deliver down lower. So as I said, COT is godlike in confirming a theory. But this is also where this takes a turn, because you cannot use COT, or personally, I developed a pretty much very good model, right? Because I use fundamentals and then I use commercial hedging to confirm my theory. So, as I said, I don't just use COT. Instead, I establish a theory and I confirm it by using the orders of real commercial central bank traders, right? Since what their central banks are looking for them in order to position themselves in a bullish or bearish manner, they're looking at fundamentals. Fundamentals never lie, right? Because then, as you can see, the large speculators follow, then the small traders follow, and pretty much move price in that direction wanted, right, by the central banks. And that's exactly pretty much why I always choose the side of the central banks, right? Since they're following the logic of where price should go, right? And that's why they're positioning themselves in a more logic manner. And that's why they're usually right. Now, they're not always right, but they usually are right. Now, let me tell you the secret about the open interest. So as I said, open interest is massive leverage positions. And so if you see new all-time highs in new leverage positions, instead of being bullish, you should be aggressively bearish, right? Because an establishment in open positions or open leverage positions in a new all-time high manner is just a bubble. You can think of it as a bubble. And so when you have a new all-time high, instead of being bullish, right, because open interest you should follow in accordance importance to if it goes up or down. So if it goes up, you're bullish. If it goes down, you're bearish. But this only occurs if you're between new all-time highs and new all-time lows. And so if you had new all-time highs, right, you're going to be bearish instead. And we're new at all-time lows, so you're going to be bullish instead. Alright, so as you can see, mass liquidations happened here. We were to follow this price, we were to follow this price, we were to be bullish, 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 and here we were to be bearish. Massive bearish lower, liquidated this low, bam, as we were at new all-time lows here. What we were looking at, well, instead of being bearish, instead of following this, we were to be bullish because it was a new all-time low. And so, as you can see here, 17th of September, instead of being bearish here, since this was all normal people following open interest, they're following, oh, is it going lower, is it going higher? Well, instead, I'm following pretty much not the change here. I'm following an inverse, right? So new all-time highs inverse, new all-time lows inverse, right? So here instead I was bearish, here instead I was bullish. So here I was to be bullish. This also confirms it, the legacy net, and so I was to see a low at the 17th of September. So from here I looked for bullish SDAs. Now a real-time example of this, and I'm going to go into indices, is an pretty much extended high dollar. As you can see, we saw new all-time lows here. That's low, right? As you can see, 18th of April, we also saw us moving from a bearish hedging program to a bullish hedging program, meaning here 18th of April or 8th of April, I was to be bullish. So here I switched to a bullish stance, and I've been bullish ever since. And I'm looking for upside potential, right? So this is a real-time example of bullish prices on the dollar before it happens, right? And they have already priced it in because they're bullish hedging, right? So until this changes, I'm sticking to a bullish dollar, and I'm not gonna change, all right? Be it everybody or screams, it's gonna sell off, it's gonna sell off. But I'm looking at fundamentals, I'm looking at what the central bank is doing, and I'm following the central bankers. I'm not just saying I'm following the central bankers, I am actually following the central bankers. That's why I took the loss today, that's why I took the loss previous week, because I know if I just follow my model, it's gonna work out. Now, if you go into indices, you know we have talked about all these specific things. But what's really important to note, right? And we can just talk about all of these things, so don't worry about them. We're gonna talk about all of these specific things. We're gonna talk about all of these specific things, so don't worry about it. So, looking at it, right? We have this COT. You have a real-time example of this. It works pretty much exactly the same. But here you're following the movement. So legacy net is a little bit different here, where you're following weekly movements of the COT to tell you the week later movements of it. So as I talked about during the crash here at 8th of April, 8th of April was here, more or less. 8th of April was here. I said we're gonna be bearish until we see COT moving up. And so we saw COT moving up, or legacy net, I'm sorry. We saw the commercials moving up, and we saw small traders moving down. You want to always be inverse from the small traders, and you want to follow the commercials, or Wall Streeters, right? Insiders. So the insiders started buying here and here and here and here, and they've been bullish ever since now. Now the first week we have gone lower, and so exactly I'm following them, and so I'm being short this entire week for Nasdaq, right? I'm looking for lower prices. You already know this, right? So I'm bearish now on Nasdaq since we saw this going down lower, and we saw the small traders piling in here, while the large speculators here as well also piled in, as you can see. Open interest is very similar to the wicks, so you can just use the wicks here instead of the open interest. I don't really use the open interest for this, but you know, you can follow the price movements here. If it goes to new, like in high, as you can see here, new high, you're gonna be bearish. And this you can show, you can just, you know, I want you guys to look at this. So I'm not gonna show you so many examples of this, but I want you guys to look at it. Don't be lazy, guys. Don't be lazy. Go in it because you're actually gonna improve so much as a trader. But one real-time example of this was the 8th of thing here. We saw the crash, we saw new all-time lows, we saw this going higher, which just gave me the confidence in pretty much positioning myself and buying stocks, etc, etc, etc. Now the same thing it goes for here. This is why I'm very confident in us going down lower. Right, let's just move to seasonal tendencies now. So seasonal tendencies, very freaking easy, and we're gonna talk about what distinguishes us from, and exactly what I talked about for indices is very different. Like we read COT for indices very differently, because they're reading it as potentially I'm doing for FX, but I'm not doing the same thing for FX as indices reading COT for indices, right? They're totally two different things. And what I would also recommend you, if you're trading indices, if you're trading futures, is to look at CFTC, right? Go into CFTC's data. They update the COT data daily. Please check that instead of market bulls if you're trading futures actively on 1 minute chart each and every day, so you can just get an easy freaking buys. All right, but let's go into seasonalities. Now seasonalities is a little bit different. Let's just look at it. They're either gonna look like this, or you have seasonalities even in TradingView charts, right? So you can actually check them out right on TradingView charts. So please go and check it. All right. So seasonal tendencies, I can just explain the US dollar here quickly since we're using it. I explain a real-time example, so I'm also going to show you a real-time example now. But seasonal tendencies, I'm reading completely different from everybody else, as I've already talked about. And we can just specifically talk about it in general. So it will either look like this, or you have it over on top of the charts already on present like price on the candlesticks, right? So you might have just this filled over it, etc, etc. There's also some indicators you can add into your TradingView charts, etc, etc. But you usually look with a 2-year-old previous data, 5-year-old previous data, 10-year-old previous data, and 15-year-old previous data, and 20-year-old data. You could even go further lower, right, or further, you know, pretty much including more data. Now, what is all of this, and what distinguishes all of these lines? Now, what distinguishes all of these lines is that the pretty much is combined data, right? So seasonalities, as I said, seasonal tendencies, you can actually just ChatGPT this, but you can actually a little bit different. You usually look quite a lot different, if I'm honest, where seasonalities actually show you what price usually done during these specific periods of time, going back in time. Alright, hopefully that explains it. If you need any specific help, you can just DM me. But that's exactly what this does. This does in 2 years, 5 years, 10 years, 15 years, 20 years. Now, what distinguishes the 2-year, 5-year, 10-year, 15-year, 20-year is pretty much that the 2-year only captures 2 of the latest years of data. Now, this could be very problematic, right? As well as the 5-year, 10-year, 15-year, 20 years. So the more years you include, the more accurate it becomes, but also the more data, the more individually less movement you'll have, and you'll also have it more delayed. So the price movement you'll also have delayed. Now I'll explain this 1,000 times, I think, but specifically the 2-year-old, right? It becomes problematic using the 2, potentially even 5-year-old, because you can have different business cycles. Now, the latest 2 years, I don't know if you noticed, but we have been in a quantitative tightening period, meaning we have had higher interest rate. We have had a higher interest rate scenario, meaning we haven't had a higher or more bullish seasonal tendency for the dollar in other, these 2 years compared to other periods where we've had a strengthening dollar usually throughout the whole year. Now this becomes problematic because the 2-year-old then is skewed, because we're going into a quantitative easing period. So how we establish this and how we pretty much focus in and trying to get more accurate data is by taking away the 2-year-old data, instead focusing on 5, 10, 15, and 20. This is usually what I do now. Now, for me to get even less skewed data, I'm focusing in on where the prices have the same moves, or where we usually always see similar moves. Now, a lot of people will be asking why seasonalities is accurate and how it works, and the simplest answer I can say is price is cyclical to an extent. It's random to an extent, it's cyclical to an extent, it's probabilistic to an extent, right? All of these factors come into play, and why it's cyclical to an extent is because people move different in different periods of the year, right? You're gonna have different periods of mining in Australia during the winter, right? Because the winter for us is the summer for them, so it's gonna be warmer temperatures, you're gonna be easier mines. But you also have the US, you have hurricane seasons, you have all of those things, which is gonna pretty much potentially become, harder for them to get some oil in the now American Gulf, right? Not the Mexican Gulf. During hurricane season, for example, etc, etc. So you usually see over the periods of year, you usually see like different tendencies for patterns of behaviors, for how minerals are mined, for how easy it is to extract these certain commodities, and you have all of these factors impacting similarity in price. So you usually see seasonally strengthening and weakening in dollars based on month to month. Now the same thing is true for indices, right? And indices is also something we're going to talk about now. This, as I said, is random to an extent as well. So price does not need to follow seasonal tendencies. But if seasonal tendencies, personally, as I'm saying, and using this as the third tool, if this aligns with your externals and your COT as confirmation to your externals, seasonalities could be a layer on top, and that's why I use it. I use it as a layer on top to confirm if it seasonally usually also happens, because that gives a more probabilistical look at what we usually do and more confirmation move. Now, what makes us totally different compared to other people in using seasonality is because we're using seasonalities not as exactly as it says. We're using seasonalities as it suggests, but in month plus minus month, right? So we're using it as a plus minus tool. We're not using it as an exact value of what price should do. We're using it as to an extent value price should do this. Now, how you do this is specifically looking at plus minus 1 month, so we can be here or we could be here, right? And that's because price could be delayed, right? Why could it be delayed? Well, specifically as I've talked about, we don't use the 2-year now, so we don't use a confirmation of a 2-year. Instead, we need to confirm it ourselves. And so 5-year, 10-year, 15-year, 20-year is always a little bit delayed data, since price moves faster, you have faster things changing in the world, etc., which could be it potentially being here, we've been here, or we potentially been here. Now, as this is in the middle, I would personally say potentially we're here, either here, or we're just here. And as we have seen the externals be extremely freaking bullish, right? So you have to think of, where is the currency? Is the currency price low? Is the currency price high? What is the external suggesting? What is the seasonality, or what is the COT confirming? And you can see if you have had an up move, down move, or just consolidation. Now, if it's usually consolidation, you don't usually see anything, but then you of course could potentially see higher prices, low prices. Depends on what seasonally it does. Now, what makes us differently is because we are more or less pricing in a delay in, always a delay in seasonality. So we're always more or less a month delayed, right? Always a month delayed. Always. And so, as we specifically said, and we can show you guys a real example of this. Real example of this would be, for example, December, right? We did not see the low prices. Remember the election, right? Election was more or less here, right? But we did not see the higher prices. We did not see the lower prices then for the currency. But remember when Trump was actually elected, we saw first the higher prices in the anticipation of elections, right? Higher prices. When he was elected, we saw low prices. But here, the currency is going higher, right? But this was not priced in, right? And a lot of people would say, nah, seasonalities did not work. But they actually did, because here they priced this in. Which means we are now in this strengthening period right here. I don't know where we are at this stage, but we have seen this, right? And so we should now see this seasonally. And as we could be 1 month delayed, we can even be here, because we have seen this lower price, right? Now, this suggests just us reaching up, taking out this specific high. Now, remember the specific high we talked about. Remember the market maker sell model. We have the reconsolidation. We should now deliver up and take the reconsolidation out, and this is exactly what this suggests, right? This is how we use seasonalities. We're going to just quickly do a little bit of a recap for them, and then we're going to move over to talking about what they specifically mean and how we specifically read them. Now, hopefully everybody is able to see this. Yes, you are. So, just starting off, as y'all know, seasonalities usually look like this. I'm gonna also show you guys an example of how they possibly could look for on TradingView, and how you locate them on TradingView, because it's also very good, I would personally say. So you locate them is by specifically go into not the flag, but you go into the data for the DXY. Now, if I remember correctly, it's more or less objective tree. Let's see, data window. Potential, no, okay, that was not it. Yes, it's somewhere here. I don't know fully. Yes, that was the yield curve. That's very good, actually. Let's see. Yield curve, options, not option, calendar, screeners. Potentially screeners then. Come on. I don't really use this, but I'm just gonna show you guys how it works. Bro, how can I do this on my phone, but I cannot do this on the computer? How stupid. How stupid for real. No. No. Here? No. Yes, I think is it security information? No. Metrics, seasonalities. Here you go. So here you can locate them, right? And this is actually pretty good. You can actually see what the DXY usually does, right? In a period, you can even zoom back. Look at this. So you can even have all this information right here. Isn't this amazing? It's potentially even better than uh, than than markables, because this provides you just with much more information, which of course can just show you in specific manner what we usually do. But as you can see right here, this is 2025. You can see we're minus 9% on the DXY, right? And this goes for all currencies. You can look at seasonalities. I would highly recommend this as well. I can specifically go in and look at different years, right? And what we specifically do. And as I said, I would not look at the whole thing. I would not look at the whole perspective, but I would look at specific dates and what we usually done. Now, for specific reference, right? I would pretty much skip the older years from 2009 and I would focus on the later years. I would focus on these right here. And if you just specify them, what we usually see is from here, we usually have seen already strengthen in price. As you can see here, very correlated. You know, we usually see a consolidation in the beginning, January, February, right? As we usually do. Now here, of course, from February to March, we have overall decoupled a little bit from the usual seasonality, since we usually see a strengthening up to June, which is exactly the thing we have looked for, right? We've looked for a strengthen, but we've not seen that specifically here. Now looking at, for example, the 2022 year, right? We saw continued strength, continued strength, continued strength until where we usually see weakness here. Now we can compare this to market bulls, and on market bulls, it also, I don't know if you are able to see this now. No, let me just change the screen here. It also suggests that we should have seen a strengthen, which we have not seen, right? A strengthen here, which we overall have not seen, right? Now, I think we will see this eventually, potentially here, you know, with this last strengthen part here. With this final drop right here, we could see this strengthen, but yet again, looking at it, right, we should already have seen this. Now, once again, we have talked about the basics here. We've talked about what the 2, 5, 10, 15, 20 represents. We've talked about what all of these lines represents. We've also talked about what this data represents down in here. I think I've not mentioned this, but this is more intra month. So this is more or less going into the days of the month where we should pretty much go. As you can see, we should be in the beginning of the month, pretty bearish. So it's just a zoomed in version of this segment right here, from this to this. That's overall here. All right. Hopefully that makes sense. So we should see a weaken, and then we should see strength, exactly as it shows right here. And even on the 2 year, it shows these things, right? Which is usually what we do. And as we talk about, this is due to multiple other reasons. But we have commodities having an impact on this, most notably oil prices, oil extraction, but also gold, etc., etc. So there's multiple other reasons why we actually have seasonalities, other than just basic human pattern. All right. Now, putting this overprice, which just helps us to pretty much look at more specifically the thing we want to specify, right? And what we want to specify is, of course, I'm gonna just put this on top right here. So you can see the dollar here again. What I want to do is just to specify this right here, and I want to do this right there. Yeah, no, the stream just ended. Don't worry, guys. I think it was because I stopped the thing and then I started the thing. But here you can see, right here, we are here, as you can see right there. Right there. There we are. So you can see, does this really correlate to what we seasonally do? And this is not overall put exactly on top. This is not the right size, but we can try to get it the right size. So if we pretty much take this to January 2025, start of January. So here you can see more or less on top, right? So we usually see consolidation, as you can see right there. Then we usually see a little bit of a drop with a manipulation coming into markets. The thing we usually see here, as you all can see. Then we usually pretty much see a stagnation in price. Instead of this stagnation, we saw this big drop. And if y'all look at this, it potentially looks like this is correct, right? But here is where it starts decoupling. But this is like what normal people see as decoupling. Now hang with me a second, right? Because I'm going to describe pretty much how we read seasonalities, which is the thing pretty much we ended up not describing the best. But here you see we usually see strengthen, which is exactly the thing we did not do. And here we see weakening, and we see a bottom in form here, and we see in higher prices settled in, and then we see lower, etc., etc. Like you can also have this. You can see usually see strengthen, weakening, and higher prices like this. Now that could all overall be right, but overall you all know that this data, since it's the mean data of all previous years put together, it should have some delay, right? Which means we should not really be at this red line right here, right? Instead, we potentially is a month earlier, right, in what we pretty much were to see in price. Now, this would make much more sense, since if you look at it, right, we saw the big drop. You can even look at it here, like we potentially were here in December price when we saw this right here, big drop, and then it just continues like this, as you can see. This looks much more correlated, as you can see. So we're here, we've seen this low settled in, right, as everybody can see. Now we've also overall seen high prices, consolidation up here. We've potentially seen a high sell in right here. Right here, we have potentially seen this drop right there. Now we should see this strengthen. So this brings me to believe, and this is how I read seasonality, since this is delayed more or less a month, we are more or less at the start of May, so we're more or less here, and we should see strengthening up to January before more weakening and then more strengthening, which would take us, if you look at it, potentially all the way up here. We potentially are not going to reach our drawn liquidity. I would like us to reach our drawn liquidity like this. But I don't think necessarily we will do so. Now, even if we are not delayed, let's say we are here, and let's see, we have this much more minimized like this. You'll be able to see that we potentially will either way take out this or this high, because you can see we are either way to pump up higher. Now we only have two alternatives, right? No, I don't take this is no, I don't. I don't, so you can remember this. No, I don't. So when the yields and the COT is not aligned, we usually just consolidate. That's literally what it means. Now, when they are aligned, we usually see very good price, and this is what I want to see. I want to see us run, because we've seen bad price action for how many days now? We've seen bad price action for since here. So for 31 days. So for a little bit over a month, we have had bad price action. As you can see, like a lot of people would not describe this as bad price action, but I would at least describe the 15 latest days, so 2 weeks of data, as bad. or potentially 17 days. So that's potentially a little over 2 weeks of we have had just bad price action overall. Since what we want to see is just the higher prices. Now we have not seen the high prices yet, and I would see these high prices sell into the markets since I don't think we're gonna take this low. Now I can discuss why we would not, but you know I've had the analysis. You can watch the analysis, right? I want to teach you guys today, and we'll see. Potentially it's real time or my bias just flops over. But in that case, we have not lost any money on it or just very little, and we can just change it for the better. But as I said, we don't change it until the seasonalities and yields have changed. Prior to us, right? So we want to not change because the structure changes. We want to change because the external changes. We want to change with the externals, not the structure. Hopefully that makes sense. I've always said that. I'm not gonna just continue saying that. Now, very big note here. Very big note. Something which is very freaking good to use is comparison between FX and currency. Alright? It's not the same. You have a comparison here, which means it exaggerates because here you have euro and here you have the US, right? Or US dollar, right? But you can take them against each other and you'll see they are very freaking similar, but they're not exactly the same as you'll be able to see. Now here, as I said, we should be able to see a drop. You can see it even on the 2-year. We should see a drop soon. We have seen this strengthen rally right here, but we should see a drop. Now, seasonalities is not 100%, end all be all, but yes, it also suggests we should see a drop coming in to Euro USD, which is exactly the thing we are looking for, right? Now, and that specifically goes for all specific data. So as you can see, this goes for from the 5-year-old to the 20-year-old. We should see a drop. Like it's all suggesting we should see a drop here, right? And I can look at the other pairs right here, and you can look at these ones as well. And I would use both of them. So I'd use this and this, which means that I don't just use one seasonality, I use two seasonalities since I use this and I use the currency I trade or the Nasdaq I trade or whatever, and I use the foreign exchange, um, like the two currencies against each other as well, since they're not always, pretty much aligned. And when they are aligned, you have a higher probability of seeing a thing in the markets, right? Let's just now go to Nasdaq, right? And we're gonna start off actually with the wicks. Now, why the wicks is specifically so good for having data on is because you usually see a spike during March and April price to May potentially. And that's exactly the thing we are waiting for, right? That's exactly the thing we are looking for, right? That's exactly the thing we saw. Now, I'm gonna lay this on top, and this is overall one of the confluences I used to predict the Trump overall the Trump tariffs was pretty much fake because we more or less always see just a dip here, and the tariffs was during this period, meaning you could never specify if it was the tariffs or if it was just seasonally what happens to price, right? And to some extent, if you have two things which is negative at once, right? If you have two things which is negative at once, both of them will exaggerate each other, right? But when one other lets go, you have a higher possibility of seeing the other one pretty much uh, intra connected, right? Let go as well. Meaning if you have seasonalities, but then you also have tariffs on top of that, right? So you have overall bearish market sentiment because we usually see lower prices here, thanks to March just being the sell month of the indices. That's usually what we are bearish pretty much all years, as you can see. This goes from 2-year to 5-year to 10 years. Is always when we see low prices. I don't know if it has to do with spending of people, etc., etc. Potentially people just are broke during this period, so they cannot go out and spend. Pretty much making the economy go round, decreasing the economy, having short-term recessions during those periods, or just low-term, or it's just business cycles in a short-term manner, which is always pretty much during the month of March, April months, always just in the recession period, right? I don't know specifically why this is, but it's just always has been this way, right? It always has just been this way. Bro, I'm sorry for my English. It just always has been this way, right? and there's literally nothing to do about it. So I'm just going with the flow, right? But now when you have tariffs, etc., as well coming into the markets during those specific periods, which is the thing I mentioned previously, you're gonna have an exaggerated bearish market, right? Now, usually, if you think about it, two bads, all right, makes the market even worse, right? But when one of them turns around, you have a higher probability of seeing the other one turn around as well by itself, since you have sentiment already shifting from bearish to bullish on one side, right? Now you have 1,000 different things, but it's called the domino effect, right? You have one brick following into place, and then that pretty much turns the other brick, right? So I don't know, that turns the other domino into it pretty much turns over the market to a bullish sentiment. Now, what's most important and what I pretty much used here is per se not the Nasdaq. This is only for indices, by the way. So instead, as I knew the wicks would spike up thanks to its seasonally doing so, I more or less instead specified I looked at the wicks, and as you all know, that's one of the things I more or less use the most to predict higher markets, right? So going over to the wicks here, as you can see right here, we usually see during the month of March, as you can see here, month of March, April, a spike. And since I knew we would overall, and as you can see here, the data is delayed a month, right? As I said, that is a delayed a month, which is very sad, right? But here's a prime example. This was during April, as you can see. Now we usually see the high in late March. Late March, I think it was even late April here we saw the high, and you can see we went lower from there. Now the same thing is true here, and this is like month delayed, as you can see, right? So we are always a little bit delayed on seasonality. This is just a prime example of us being delayed. But you can see right here, we were more or less delayed a little bit. But laying this on top, we knew that April we would look for declining prices. So from April onwards, we will look for a decline, as it always does, as you can see. Now, as you can see, April onwards we declined, right? And instead of using per se Nasdaq seasonalities, I use the Wix seasonalities to predict S&P 500 and S&P 100 to predict Nasdaq, right? That's something you could do. So the Wix is very, very good for predicting higher prices, especially when you have a Wix high in, you have a low in, so it's inverse from S&P 500 and therefore Nasdaq, right? You could potentially watch for SMTs, etc., etc. It's best place to watch for SMTs right here at all these small peaks, right? And as you can see, it's declining, which means we should see higher prices per se for Nasdaq, right? And for S&P 500 as well, as you can see. Yeah, as you can clearly see right here. So it just means higher prices, etc., etc. Now, going into seasonalities here once again for Nasdaq. I'm just gonna showcase that. Then we're going to go into more interesting stuff. We're gonna go into dark pools. As you can see right here, we usually see a decline, right, during the month of March, April, right, and then we usually see higher prices. So this is just a thing you could use to predict the low for Nasdaq, S&P 500, this dip as well. So I only had this exaggerated, but of course this is just one brick or one domino of all the rest of the dominoes. But as soon as one domino turns, you potentially gonna have other dominoes turn as well, as in the domino effect, right? Where you have dominoes falling on top of each other thanks to domino turning. So as soon as you have some dominoes turning, aka some confluences pointing in direction, now you should have confluences which is real freaking good, right? Since that's why you want to specify your concepts, you want to specify your model. But as soon as you have some parts of your bias shifting, the other parts of the bias will most likely follow if you're leaning in that direction. And I think you can clearly see a directional shift now in the yields. So yields has actually started delivering down lower now. This is just a prime example of a real-time explanation. So this is like real-time example of the thing I'm trying to explain to everybody here. So real-time example of this, if you all go into looking at the yields now, right, the US 10, US 30, why? You can see they have pretty much continued down lower. They have gone down lower now. Exactly the thing we are watching, right? But we're still watching a higher move for the DXY, right? But that's the first domino. It has already started falling in place for a lower dollar down the line, down in a month or something like that, right? Because we want to see first an up on the DXY, take out buy side liquidity, and then the buy side, after taking the buy side liquidity, we want to see lower DXY, right? Now, potentially we won't see a higher DXY. It depends on how fast the dominoes turn. How do you measure the dominoes turning, right? It's just a simple like methodology, all right? It's like just how I think of how the market works, right? Well, you look how fast the market is moving. If you see the yields dumping, as we've talked about, you have dominoes turning fast because then you're going to see COT shifting fast, confirming our theory, which means we establish a different bias, meaning a lower DXY bias, right? Now you always want to use the differentials, meaning you always want to use what the yields were equivalent to where the DXY's price was in accordance to changing the state of deliveries, etc., etc. for the yields. This is just continuing with a real-time example I'm just showcasing. Please annotate this into your notes. However, the yield's price will be mirrored by the DXY later because money seeks yield, right? So you want to see the money following the yield prices. Hopefully this makes sense at least. So you know we're gonna go lower eventually for the dollar. But as we have gone higher before lower, we want to see higher prices for the dollar before lower prices. Now I don't know if Donald Trump is gonna screw this over because he's also a domino in this, because he's a very unpredictable domino, which can just turn very fast. But we'll see, we'll see. I think we have the probabilities on our side, right? Probability is a little bit skewed thanks to him. But let's just go into dark pools, right? Let's just move on here. So let's just overall go into dark pools. Just wait 1 second here. I just need to fix it. I thought I needed to log in, but it's fine, it's fine. I don't really need to do it right now. But yeah, I'll pretty much here you have really interesting stuff. Like this stock grid is very freaking good. Like this website is very good. But if you overall need to read more about in a textual manner, dark pools, I would highly recommend this. Markables is actually very good in these sort of things in terms of explanations of these things. So I would definitely recommend this right here. So read this if you're interested more in like dark pools, etc., etc. But yes, let's just go in and explain this as well, because this is overall another sort of data I use outside of the charts, right? Which help me to eventually identify moves, but specifically this goes majority for indices, right, and futures. So this is what I use for futures. This is not specifically what I use for FX, right? They don't work for FX. Like you don't have specifics for FX, right? You don't. Oh, I'm sorry. You don't have what is it called? Dark pools for FX, right? You don't have any dark pools for FX. You only have it for indices and other equities, right? It's options, right? It's options, and it's just other brokers. Now we'll go into this. We'll talk about what all of this means, etc., etc. We're gonna talk about how I read all of this shit right here, and we're gonna just talk about in a structured manner what and how I use all of this, right? So overall, starting pretty much right here, we're pretty much you're seeing the date, you're seeing when it's updated. As you can see, it's more or less updating each and every freaking day, which is very good, right? Use this data. Now this is option QQQ is the option flow for Nasdaq, so it's just a options version of Nasdaq, you can say. So it's, if you're ever trading options, right? You're trading Nasdaq. You want to trade Nasdaq. You're trading the QQQ. It's the equivalent to Nasdaq, but just some options, right? Which is another financial instrument. And this only is for. Oh, you can use this for Tesla as well. It's very good. Like Tesla is the biggest one. You can see net short volume today, and the net volume, pretty much the positions, the dark pool positions, as you can see here. The DP positions is called DP. I don't know why, but it's just called DP. Dark pools, you know, it's just short for dark pools. It's just the biggest it is on Tesla, which could potentially mean big upside coming for Tesla, right? Who knows, guys? Who knows? Or big downside coming for Tesla. It depends because I'm gonna explain all of this, but it depends on you have to overall figure out the structure manners, and you have to use the COT and the rest of the data to try to figure out where the options is leaning, because you can only use options uh, to predict. You know, you don't see if it's short or long orders. Like you don't see if the dark pools is majority longs or majority shorts, or potentially you could see a little bit, but it's not really how I use it. Instead, I use the number of positions in dark pools to determine if an high or low is in. Because if I'm anticipating a high getting in and I see options spiking, that does not mean it should go higher. It means that we should form a high and that we should deliver down lower. Since I don't know if those option flows or not option flows, dark pool option flows is bearish or bullish in the majority of them. Instead, I look at the dark pool orders is going up. I'm looking for a high being in, and so I think the majority of them is shorting or shorts coming in from big institutions using dark pools. All right. You can of course also see short volume, but I don't think this helps you anything. Like it does. Look at this. Does this help you personally? Like here, it literally would obliterate you, because here it says, oh, the short volume is crazy, right? It pretty much went down like crazy because all people shorted here. Now they got liquidated, so potentially inverse this shit. But this is like super retail stuff, but I would not use this. I would instead use this, and I'm gonna explain this right here and this right here. But only potentially this right here. This would help me the most, and I'm gonna explain all of this, by the way. So, sorry guys, but let's go into this. So, starting off, as you can see here, you can see it's updating each and every day, which means you get new freaking data each and every day, right? For dark pool orders, etc., etc. Now I'd look for total volume, and I would look for how this changes. I'll look for short. I would not look for this actually. This is this is volume. I would look at dark pools. So I'd look at the total dark pool orders, right? So I'd look at this right here, dark pool orders, and you can structure it as the lowest ones to the highest one. But you can see the highest ones is Tesla. And we can talk a little bit about Tesla because we can give it a prime example. We can first go into structure, and then we can define if we're looking for a high or low getting formed, and then we can, personally I'm looking for a high getting formed, and then we can pretty much use this dark pool potentially to trade Tesla. If you were to trade Tesla, you can confirm it through dark pools here. And I'm looking for a high get sold in, and that could potentially also help you. I'm gonna drop the website here. It's called stockgrid.io. Let's see here. No, come on. Okay, I'm just gonna redo it here. Bam, there we go. There we go, guys. Here you have it. Yeah, now I lost myself. But yeah, I would not look at the real stuff. I would look at the real stuff. All right, and we can do a real example of Tesla, for example. Now I remembered. But it's a really freaking important because remember what Tesla is, guys. Everybody, open your ears. Put this into your notes. If you're trading indices, or if you're not trading indices, potentially think about going into indices when FX is super bad, right? But think about it logically here. All right, guys. Please listen up. So, if you think about it, if Tesla is expected to have a high, right, it's one of the dominoes pretty much being a big part in Nasdaq, right? The index Nasdaq, right? So if you think about it, what is the index, right? It's pretty much a composed stock, right? Or composed stocks, right? So it's individually stocks making up overall uh, a thing to predict. I think it was pretty much to predict the stock sector of the economy. I think, like S&P 500, it was to mimic like the U.S. growth of all U.S. economy, or the growth of yeah, Standard and Poor pretty much merged, blah blah blah, as formed S&P 500 with the 500 biggest stocks. You get it. Um, if you don't just read about it, I guess. But yeah, but as you can, bro, I'm super sorry. I'm a little bit tired, but yeah, uh, Tesla, right, makes up a big part of Nasdaq. So if you're expecting a high getting formed on Tesla, which I am, you're also potentially expecting a high getting formed on Nasdaq. It's one of the dominoes. Now you can potentially do this for Rest. You can do this for um, Nvidia. You can do this for whatever you want, right? And I would personally do just for potentially a stock you like, right? And you just have that as extra confidence for what you're looking at for the QQQ or Nasdaq, right? NQ. But looking at here, right, we have seen a decline in dark pools right here. Now, this does not mean anything specifically, right? Since we all have this. This is the net positions, right? We have net positions, we have net short positions, you can see right here. We have net, you can see just the price in general, the total volume, as you can see. We have the positions in terms of market cap, in terms of millions of dollars, right? And you have the net dollar volume in terms of dark pools, right? Now, what I would specifically look for, right, is the total volume. I would look at the total volume and what the total volume does. So I would not look at the short volume or the net volume, all right? I look at the total volume, the purple thing, right? Since that gives me an edge in predicting highs and lows, all right? How do I predict lows? Well, I predict lows and you predict highs through overall, but it's most evident in lows, right? Since you have large institutions buying the dip, right? So when you see a spike, so for example here, when we can just take this example, which we have gone through now in terms of seasonalities, etc., etc. Now you can see here the net positions here, net rolling positions. You can see we're buying, 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 selling, selling, selling. But what's interesting is, well, we had the selling, right? As we had the selling right there and formed the low, we had this mass institutional buying. Now, institutions is the one own, which is institutions is the only ones using dark pools. So we can see when institutions is buying, we can see when retailers is selling. Now, you can use another alternative method here, all right? And this is something I'm going to showcase. So this is like a layer on top of the layers I've shown you guys, and I'm going to talk a little bit more about a lot more about dark pools because it helps you predict highs and lows, and I'm going to showcase how. But I'm just going to show you a real-time example of this. So as you can see, we're only looking at the big purple line, or this is the purple thing, right? We're looking at the institutional buying and selling. We're looking at dark pools, net total positions of dark pools, like the total volume, right? That's what we're looking at. And you can see if it increases, if it is spiking. If it's spiking, you think of the wicks, but then inverse wicks. So if it's spiking, we see a low sell in and we see overall high prices for indices, right? So we see this means high prices for indices, high of this, if you're expecting a low. So if you're expecting a low structurally, right, by COT, etc., and you see this is just your confirmation that the institutions is buying. If you see the spike like this, if you see the spike and you're expecting a high get a sell in, through COT, through seasonalities potentially, through structural manners like ICT, etc., you see a spike. This means a high is in. You can see a high pretty much right here. Now it's not always the case, but you can see a high right here. We saw from this, you can see from the previous days. Look at this spike. This is a spike, guys. This is a spike for institutional selling, institutional selling, institutional selling, if institutional selling, potentially a little bit institutional buying here. And then you saw this bam, and then you saw this big ass spike right here. Now that pretty much sparks a low, for me at least. As well as the net positions here being very short. So you can see while they were shorting here, while the majority of the retailers were shorting here or selling their stocks or selling their QQQs options, institutions were buying QQQs through the purple, as you can see, dark pools, and they are the only ones having access to them. You see, but also real interesting. You should always update y'all on not any of these, but you should always have an update on the dark pool positions, right? The total dark pool positions, as we talked about, the DP positions right here, the DP positions right there. That's what you should be focusing on. Not this. Don't skip this, by the way. Like, just totally skip this. I'm sorry. Totally skip this. Now we can go into Tesla here. We can talk about Tesla here as well. But yeah, I'm expecting a high get settled in here since we've seen crazy much dark pool data. I know we've seen crazy high data. Plus we've seen pretty much retailer buying, right? As you can see, many want to see low prices here. Yeah, but let's do the layer on top here. Let's do the layer on top. So COT reports. We're going to go into S&P 500 or Nasdaq because we are looking at the QQQ. So let's do the QQQ and let's do the third layer here. So this is the third layer, right? And we go here. As you can see, during the dip right there, you can see how much small traders right there and large speculators. Now, large speculators means pretty much pension funds, etc., etc. So it's not Wall Street. This is Wall Street, right? This is what we're looking at Wall Street potentially buying, right? Or selling. You get it. But here you have large speculators and small traders. They're always selling into Wall Street. You want to be looking at what Wall Streeters is doing, right? Now you can see from this dip right here, they sold off massively the small traders, right? The small traders were obliterated here. Who do you think they sold to? As you can see, they sold. Well, they sold to what happened here. Well, as you can see, prior to the dip, right? You can see the dip was 8th of April. 8th of April was here. Now from 8th of April, what increased? Well, we can see the COT for the commercials increased. So who do you think is buying this yellow or I'm not this purple compared to here where we saw minimized? Look at this minimized. Look at this. Like if you were to look at the line, the horizontal line. Everybody look at the horizontal line right there. We have an increase in the horizontal line, the average horizontal line to here, meaning Wall Street is buying, and they have been buying this whole dip. Now, how do you predict the high? Well, you predict the high through declines and pretty much net short positions increasing. So you look at the net short positions, not these ones right here. This does not help you. This right here, the rolling 20-day positions, while looking at the price versus short volume. All right. And you look at this and you want to see pretty much this right here having a spike, like we've talked about spike, and want to see this decrease as well as potentially this decrease as well, the COT for commercials, right? So you want to see commercials lower, you want to see this going lower, you want to see it spike here. We have not seen it spike yet, but potentially tomorrow, like this updates every single day, so you have an update every single day for the dark pools, right? So you can potentially see a spike here tomorrow or something like that, or any of the stocks, and then you'll see big drop. So this means an high is not in yet. This means an high is not in yet, but when we see it potentially tomorrow and spike. So let's say we see something like this. We see something like this. We see something like this tomorrow. You can freaking start looking for shorts. You can freaking start looking for shorts. Since we've seen this 20-day rolling positions gone even lower, plus we've seen the COT commercials starting to sell. Plus the look at the little small traders right here. they have actually increased. So this is how I look. This is like another layer on top of how I look at the structure manners. So now let's actually go into indices, because FX has been so shit, all right? And we don't necessarily, we can do a quick analysis before we finish off on FX, but I want to do it since we've gone through the things on top of the charts, right? Or the things which people would call fundamentals. This is the thing we've gone through, but we've literally gone through the commercials, right? We are always trying to look for a lens through commercials, right? So let's go through the structure manners of Nasdaq now to finish this off. Since we've talked about seasonalities for Nasdaq, we talked about all of these things, but let's go through the structure manners of Nasdaq right here. So looking at the structure manners right here for NAS 100, right? We all know what we're looking for in an institutional manner, right? In looking at the real like flows for dark pools, etc., etc. We know we have big dark pools coming in shorts here. I've sent it to you already. We've seen big dark pool position shorts. Now that's another website I use. It's a volume, pro volumes or something like that. You can use provolumes.se. No, not se. I don't know what it is called. You can look at it, but it's just Volume King, I think it's called. Search that, and I can actually just search that really quickly. But I think this Dark Pools website, the other one I showed you guys, is much better. If I'm honest, I think it's much better. I'll just send it to you later. But I think this StoICTrader is much better. All right, for looking at these things. Let's continue here, looking at the structure manners for Nasdaq, right? So as y'all can see, like we're overall looking at this liquidity potentially. We have a high liquidity. We have a high here, which has large quantities of liquidity, which we potentially could get taken out tomorrow, right? Since we have not seen a spike in dark pools yet, as you can see. And I'm just gonna print down top actually. So since looking at this, we have not seen any spike here, right? But we have seen this decline, right? This right here, we have seen this decline. We're looking for a high, we're looking for a slowdown in price, and we're looking for a high sold in after liquidity is taken. Meaning we potentially want to see this, then we want to see this spike since we have the COT right here, as you can see right here. Since we have the COT bearish, as you can see, it's going lower while the small traders is buying. Now we never want to trade with the small traders, and we always want to trade with COT or the commercials. So since we have seen this right here, we should now be able to see this getting liquidated, and then bam, big drop, and then high prices once we see another spike right here and more liquidity getting taken out. Now that's exactly, I've been bearish for Nasdaq for so long, and I think no one is even trading it, because I don't know if they're waiting for shorts or anything like that, but I'm just waiting for shorts for Nasdaq. If I'm honest, I'm just waiting for shorts. Now, I've said it for weeks now. Both FX and Nasdaq has been pretty poor in providing setups, but yeah, I think we will get provided with some setups real soon at least. But I'm gonna just show you one more thing for Nasdaq E-mini here, and that's just its seasonal tendencies here a little bit, and I'm gonna lay it on top and how it the structure and pretty much all things pretty much goes together here, right? Of the things we are looking for. Or you can do it yourself if I'm honest, but you can just have it as a homework. Anyways, any questions here? But I'll just show you some more. Our John liquidity here is just the low here, and then I'm gonna just go through some analysis for FX, right? But it's just the sell side, so I'm just gonna annotate the sell side and this buy side right here up here. So like I said, I'm not mega bearish, right? I'm not, crazy bearish for Nasdaq. I'm just short-term bearish since I want to see higher prices on Nasdaq. But for us to see high prices, I think we need to go higher than lower, right? I think we need to go for the buy side and then reach for the sell side, right? Hopefully that makes sense. Any questions in today's call? Anything you want me to go through? Any specific assets? Or anything you like in particular about the call? Or just want me to talk about? yeah, I always try to go through these things like real time, show you guys real time examples of the things I do. But yeah, I think it's good. I think it's good. So you have the three layers, and you also of course have the home builders suggesting lower Nasdaq here. So you have the home builders also, you know, showcasing a future direction lower, as you can see, and then we've seen pretty much higher prices here for home builders just these two last days. But just calculating this picture right here, we should at least see a drop like this for Nasdaq, and then just upside potential. So you have the externals right here. You have, of course, also potential tariffs coming into markets and other things like that. For the DXY, I'm just looking for upside potential since we have not changed our buys in an over higher time frame sense. Your USD, just same thing, just drop here. I would not want to see this high getting taken out at least. So we'll see those things potentially. We'll see if anything of those things happens. But hopefully you guys like this call. Pretty long call. Tomorrow we're gonna go through the structure manners, right? So we're gonna go through everything I do in terms of looking at charts tomorrow. So charts analysis, right? So we have done through everything I do outside of the charts in a simplistic manner, except for market correlation, statistics, etc., etc. Those things we have not gone through, and we will go through them eventually, but we're gonna instead stick to structural manners. So we have talked about confirmation manners, so we have talked about COT, seasonalities, and dark pools. That's the three things I use to confirm my theories established by market correlation, statistics, um, and intermarket connections. The So yeah, that's pretty much the things I use. But tomorrow we're gonna go through structural, and then we're gonna go through statistics, and then we're gonna go through market correlations. So hopefully you like the setup. I'm gonna go through pretty much all things I use. So my methodology is more or less, but in a more in-depth manner. So it's very short alike. It's very